You're scrolling Instagram. A woman films herself in a Dubai apartment. Ocean view, marble floors. She says she bought it with no cash. Her secret? A personal loan? In Dubai, this isn't smart leverage. It's delayed damage. In Dubai, personal loans often cost 8 to 14% interest.
How?
Look at the other side of the equation. Rental yields on prime apartments average 5 to 7%. And that's before you account for vacancies, service charges, and maintenance. When you borrow at a higher rate than your asset is returning, you're guaranteeing one thing: erosion. You're paying more for the money than the money is earning for you. It's a simple, brutal calculation. This isn't a complex financial instrument. It's a hole in your pocket. The math just doesn't work, and any strategy built on a flawed foundation is doomed to fail. This situation creates something called negative carry, or negative cash flow. It means the property doesn't pay for the debt that you took on to acquire it. The rent coming in isn't enough to cover the personal loan payments. So every single month, cash leaks out of your personal finances to prop up the investment. This isn't because of bad luck or a poor rental market. It's because of the initial structure of the deal. You've locked yourself into a financial drain from day one. It's a slow bleed, a consistent loss that depletes your capital and adds stress, turning an investment into a liability. Now, let's factor in a common reality in Dubai: delays. A project's handover slips by a few months, maybe even a year. The fit-out and furnishing take longer than you planned. During that entire time, the rental income is zero. There's no tenant, so there's no money coming in. But the personal loan payment, that is not zero. It arrives every single month on schedule without fail. Those missed months of rent, while you're still paying high interest on a loan, compound fast, digging the financial hole deeper and deeper before the property has even had a chance to generate a single dirham. So, what's the exit plan? Usually, the idea is to refinance. The plan assumes the property value will appreciate quickly, allowing you to get a proper mortgage, pay off the high-interest personal loan, and then have a sustainable financial structure. But this is a huge assumption. Valuations follow strict rules and market data, not Instagram hype. If prices stall, or if the market cools even slightly, the valuation might not be high enough. Worse, banks might tighten their lending criteria. If refinancing fails for any reason, you're stuck. While the personal loan and its high interest rate stay right where they are. Okay, let's talk about the banks. UAE banks don't care about lifestyle videos or how good a property looks on social media. They have a very clear, data-driven process. They care about your income stability and your total debt exposure, what's known as your debt-to-burden ratio. Taking on a significant personal loan instantly reduces your borrowing power for the future. It's a red flag on your profile. Single personal loan used for a down payment can block you from getting a proper mortgage later, or even from financing other better deals down the line. It limits your options severely. Think about the psychological impact. High-interest debt creates a constant nagging urgency. This pressure kills good judgment. You're not thinking strategically anymore. You're just trying to stop the bleeding. You rush decisions. You might accept a lowball offer to sell or take on a less-than-a-deal tenant just to get some cash flow. But you compromise on your standards. You stop investing and you start reacting. Your entire relationship with your asset becomes one of anxiety and damage control, not long-term growth. The debt dictates your actions, and rarely for the better. Fundamentally, using a personal loan for a property down payment is a category error. Personal loans are consumer tools, designed for things like cars or emergencies. They are high interest and unsecured for a reason. Property, on the other hand, is a capital allocation. It's a business decision. When you mix the two, you move a business risk directly into your personal life. If a property deal fails, if the market turns or you and find a tenant, the business can be wound down. But the personal loan debt doesn't disappear with it. It stays with you, attached to your personal name and credit history. The real path to owning property in Dubai is slower, but it's stable and sustainable. It starts with savings, building a solid financial base. It involves exploring legitimate structures like partnerships or joint ventures to pool capital. It means taking advantage of developer payment plans, which are a form of built-in, often interest-free financing. The sequence is critical: liquidity first, then leverage. You need to have cash reserves and a stable financial position before you even think about borrowing. This sequence is what turns the exposure of a big purchase into a controlled, manageable investment. Every dirham that you don't burn on toxic, high-interest debt becomes your optionality. It's the money that can be used for a proper down payment on a better property. It's the cash reserve that protects you if you have a vacancy for a few months. It's the capital that you can deploy into other long-term investments. True wealth isn't built by flexing with shortcuts that put you in a fragile position. It's built by order, by discipline, and by following a logical, proven sequence. It's about making choices that increase your options, not ones that take them away. Thank you for watching.